Sisonhomes podcast. My name is Christina Sison, your real estate for all season, and Mariel Kevin.
Hi, everyone.
So we have a very special guest today, and he's going to talk about some myths of lending and some portfolio lending and other things you need to know about mortgages. So with that, our guest for today's segment is Omar Sadiq from Intercoastal Mortgage. Hi, Omar.
How you doing? Thank you for having me here.
Oh, it's nice to have you. Tell me more about the mortgage industry.
Well, Omar Sadiq, I'm with Intercoastal Mortgage. I'm a loan officer there. So we're a local lender, headquartered out of Fairfax, Virginia.
Okay, great. The mortgage industry right now.
Absolutely. I would say, it's a little bit tough time for the entire real estate mortgage industry because inflation. Inflation has reached historical highs probably earlier this year is the highest we've seen since probably the early 80s, so over 40 years.
Wow.
It's slowly calming down. Inflation, the numbers were 7.4, I believe, for October, and the November number just came out today, I think, was 7.1.
Perfect.
So
Right.
that's a good sign. Interest rates are tied to inflation, basically. When inflation is high, the Feds have to increase their fund rates, and in turn, that money is offset to the banks, so they have to increase their rates. So mortgage rates go up as well. As inflation calms down, we'll slowly see lower mortgage rates. So I believe the Mortgage Bankers Association predicts that the rates will be, at the end of next year, so we're talking 12 months from now, will be about 5.4%.
Oh, that's awesome.
Yeah.
That's a prediction.
That's
Yeah.
a prediction. It doesn't mean it's not etched in stone.
Yeah.
It's not,
But that's good. They say you marry the house, you date the rate, right?
That is exactly 100% accurate.
Yeah.
That's 100% accurate. That's the biggest thing now is like people are freaking out about interest rates. A lot of people are holding off buying. At the same time, a lot of people that purchased a home in the last 2 years. So if anybody bought a house in 2020 or 2021, they got a great rate. Like really, possibly in the high twos, if not low threes, even early into this year. Or if they bought before 2020, they probably refinanced in the last 2 years. So which causes a little bit of an issue as far as inventory goes because a lot of people that are now sitting on a property.
They don't want to sell because of their interest rates. Yeah.
Exactly.
So it will cause shortage also of homes out there, right?
Right. That is correct. Even before 2020, there was a great article. I could send you a link to it. It talked about why mortgages are so expensive. Not mortgages, excuse me. Home prices have soared. And it really comes down to regulations. So the more regulations there are, so you have land developers and you have home builders. So the more regulations there are, it's just a ton of obstacles that the land developers have to go through. And it costs a lot of money. So they offset the money onto the home builder. And the home builder offsets their costs onto the end buyer, basically.
So are you telling me it's still a good time to buy? Do you think it's a good time to buy?
Okay, so the pros and cons. The con of buying right now is since the rates are higher, although they have come down a little bit the last couple of months, the rates are higher, your monthly payment's going to be higher. That being said, when the rates come down, you could always refinance. So if you purchase now, the advantage of buying now is that it eliminates competition. So what that means is that you can actually get something at asking price or even lower than asking price, and or have a bunch of contingencies on there to protect yourself. So if you have contingencies and you have something where, and get the home that you want at a slightly higher rate now, or just say higher rate now, then when the rates when the rates come down, and they will come down, it's just a matter of when and how much.
So you just date the rate. That's what they say.
You're dating the
right?
rate for a year or 2 years, then you move on.
Yeah. Exactly.
On to the next.
Yeah.
No, but that's how it is, basically. I mean, buy a house now. I mean, even Dave Ramsey, you guys know Dave Ramsey. I saw one of his videos recently, this past week actually. He said, buy now. Buy now, and when the rates drop, refinance. All signs point to rates coming down within the next year or two.
Yeah, especially with this market in the DMV, there's so much people with great jobs and great, and less inventory of houses.
I mean, I remember vividly in 2008 when there was a nationwide crash, And what happened was that I was looking to purchase a condo in Arlington, like North Arlington, Clarendon, Boston area. And I was like, yes, I was hoping the home price would come down and get a bargain, a steal.
Yeah.
The condos that were selling for 400,000 went down to maybe 390 or so.
Yeah.
There was
Fantastic,
almost nothing. However, if you went further out towards
they went down.
my brother owned a townhouse in South Riding, and his property went down like 100,000. So the further out you went from DC, you felt it a little more. That being said, I mean, we're in a nation's capital. The federal government's here.
Yeah.
So the 2008 crash really impacted Miami, Phoenix, and Vegas. Those are the three markets that got hit really hard. But we're pretty. I don't want to say sheltered. But we are going to feel it a little bit.
Yeah.
But we got a very stable economy because the government is here.
Absolutely. Absolutely. Yeah.
Back to the question as far as dating the rate goes. Absolutely, I would just say go ahead and buy the property now.
Yeah.
And
enjoy it for 2 years.
enjoy it for 2 years. Now, I can't guarantee that it's going to say with 100% certainty rates are going to come down, but all signs point to the fact that it is going to come down. It's not going to come down. It's very unlikely that it'll come back down to like the high 2s and the 3s. Those are like historical lows. But if we can get down to like sub 5,
Oh yeah,
that's
absolutely.
phenomenal.
Because those are the rates before. During the 1980s, right? The rates were like 9%, 13%, and people were like okay with it. Like, and then the 2009, I remember it was 6%, and then people were still good, and then it went down to 3%. I couldn't believe it, and then they're complaining. Now they have 6%. They're still complaining. I mean, it's such a. We should be happy right now where we are actually, because your monthly budget is set, right? And it doesn't fluctuate. You know what you're going to pay for 30 years. And if ever, there's only a chance for it to go down if you refinance, right?
Right. And I remember when I purchased my property in 2006, I paid 6 3/4. It's roughly where we are right now.
Correct. Yeah. I think it's just because, the rates were like 2.67, 3%. You got spoiled.
Yeah.
And it's actually really, it's not real. I was like, I couldn't believe it. Just, lock it in right now.
It's not sustainable. Those rates are not sustainable.
It was not, yeah. But, so Omar, tell me more about the portfolio loans out there. What if, like, I can't qualify? Are there, like, there's some buyers right now that cannot qualify for certain loans. Let's say, what would, you're from Intercoastal. Now, what would
Correct.
Intercoastal offer to our clients?
Right. So what a portfolio loan is, that it's basically our own money or our parent company's money, basically. So we don't have to adhere to Fannie Mae and Freddie Mac's guidelines. So the programs change over time. The one example we did on a business transaction together was that we had a person purchase a condo, and when the condo docs came back, it looked like, I think, one person owned, was it 36% of the property?
Yeah, like 9 units, I think, out of
Right. So they can't, the guideline is Fannie Mae, Freddie Mac.
You
Not
cannot.
a single person, one person cannot own more than 25% of the units in the building. So, and the reason for that is, what if that one person goes bankrupt?
Then
So-
it's going to affect all the units.
Correct. So they're not going to collect roughly 25% of the condo fees in the building. So that's why they implemented that guideline where you have one person cannot own more than 25% of the units in that building. So in this case, I think that one person owned 36%. So luckily, we were able to get an exemption. But that being said, if the exemption did not go through, we did have a portfolio loan, which was our own money. So we did not have to adhere to that guideline. So yeah, it's just another loan program that we have that is our own money, basically. So
with a slightly higher rate, but
again, those rates vary. We had incredible ARM programs in the spring. So, and ARM programs that were very popular in the spring. What happened there was they were non-existent for over a decade, not since like 2006 or so, where the ARM programs even exist. Then, beginning of this year, rates were in the low 3s. Then it just started going up. It's every couple of weeks, the rates just kept going up higher. Then ARM programs, which are, by the way, adjustable rate mortgage programs.
Yeah,
So
you
wanted
have
to
to
define
state
that.
that, right?
Yeah, we can't assume people know what that is.
Yeah.
So what that means is that, for example, a 5-year ARM program, it's still a 30-year loan, but the first 5 years, the rate is fixed. After 5 years, so on the beginning of the 6th year, the rate adjusts. So the advantage of the ARM program is that if the rates were lower than the fixed rate, so in that case, if the rate is like a good half a point to a point lower on the ARM program, just go ahead and do the ARM program, and in the next year or two, when the rates drop,
And
which
you can also take advantage of that.
exactly, and that I was encouraging all my buyers to do ARM programs until very recently, the last couple of months. The ARM programs, nobody has good ARM programs anymore because, again,
Everybody just think they're going to go on programs.
well, the reason for that is because all signs point to rates going down in the next year or two. So banks make most of their money the first year or two. So if they know that, hey, people are you're gonna give them a really low rate, and within a year or two they're gonna refinance, they're not
That's
gonna.
the point, yeah.
Right. So right now, ARM programs they're non-existent again. It's just that nobody's doing them anymore. But again, in the springtime and early summer, we had some great ARM programs, and that was also our
great.
portfolio loans, and those are actually noticeably below the actual 30-year fixed rate programs. Right now, the ones we have are slightly above the market rate. We're only doing those in those cases, unique cases like the situation we had there where they couldn't get their loan docs or the loan approved.
Do you have restrictions on condos, like for investment properties? Do you have a
Well,
certain
you have to
point
put more.
higher?
Yeah. So the way the investment properties work is that normally for a 30-year fixed loan program, a person would put down 5%. Unless they're a first-time home buyer, they could put down 3%, or there are other programs for first-time buyers that it's even less than that. But generally, for somebody who wants to get a 30-year loan, it's 5% down. On investment properties, because investment properties are more risky, and the reason for that is you can buy a property and you can find a tenant, and if that tenant is irresponsible, doesn't pay up, that burdens you. So it's a lot of it's out of your hands. In other words, you could be a responsible person and have a good track record, but if your tenant is not responsible, or maybe they're facing tough circumstances, now that's out of your hands, which means that so you don't control your destiny quite as much.
Right.
So that's why it's more risky for the lender. Therefore, they want more skin in the game. So instead of 5% down, most lenders, programs want 20 to 25%. Plus, the rates are generally about half a point to a point higher than the regular 30-year fix. So right now, if you can get a 6.5% rate on a 30-year fix primary residence, the investment property would be maybe 7 to 7.5. Yeah. So investment properties are hard to come by in Northern Virginia. You have to put maybe a little more money down, or you have to find a good realtor like Christina here. So a lot of them you have to maybe do like fixer-uppers.
Yeah, it's very hard because right now, like when you want to invest, your mortgage has to be at least equal how much income you're going to get. And usually right now the disparity because the interest rate is so big, so they don't get their money back. So it's sort of like hard to navigate. So we're just going to concentrate on all these first-time home buyers that have good interest rates.
I have a couple more notes about that.
Yeah.
So as far as so once you buy the property, the other, I don't want to say issue, but the other factors you have to consider when you're an owner of an investment property is that when it comes to if you want to purchase another property, so let's just say you rent out your property for $2,000 a month. We can only count by regulation. It's out of our hands.
75%?
Exactly. So 75% of $2,000 a month, we can only count $1,500 of income towards that property.
So you have to come up with a ratio that matches it. It has to sufficient income.
Right.
Subject. Yeah.
So really quick crash course on mortgages from a high level up. So what do we lenders look at when we give out a loan? So it's called the 4 C's: cash, credit, capacity, and collateral. So this is part of the capacity. Capacity means your income and your debt to income ratio, DTI. So it means how much money you're making versus how much debt you have. Now, when you have an investment property, the mortgage on that is a debt, and how much money you collect on that is an income. But it's 75%. It's not 100%. That's the one thing you have to consider when having investment properties.
Okay, and then what about for self-employed buyers? Because we have a lot of young business owners right now watching. They just started their business. They own it for 2 years now. Some of them not even, but they're in the same industry as they were when they quit and they formed their own business.
Yeah, you have to have 2 years of. We look at 2 years of history for personal and business tax returns. We need both. So it is a tough situation right now, especially in 2020. A lot of people have to shut down their business. We really can't count. We just need 2 years of history, unfortunately.
So, but then if you get employed to another company and they give you an offer letter for a big company, you can qualify for a mortgage, right?
Are you talking about as an employee?
Yeah.
Absolutely, absolutely.
So, so it would be like if you really want a house and you own a business, put it as a side business. Work with a big company that gives you full time benefits, the W-2, and then get a house,
income.
and after 6 months maybe form your own business again. You know,
I'm closing on a loan right now, and the client was actually self-employed. It's 1099. So they didn't have 2 years of history. So what we did was we asked his business, his company, small. Luckily, it was a small business. We told him to ask your employer to convert you to a W-2.
Oh, wow.
And he was able to do that.
Wow. That's great. That's a nice employer.
I know.
So.
Is that common or not really?
It can be done. I wouldn't say it's common, but it can be done.
It could be like in any industry. If you have I have a client before. His family has a big contracting firm, and of course it's a family company. But she doesn't work there, and she wanted to buy a house. She was working as a creative consultant, and I said, you cannot qualify for a mortgage. Go to your parents and see if you can get a job in your firm. So I don't know what type of work she did, but apparently she had W-2s after, and then she was able to qualify for a good mortgage. I mean, she can pay for it. It's just that you cannot qualify because that's the biggest problem right now, like of young professionals right now. I'm putting on my own business. I can't qualify, and I want to qualify. Like, well, how would I qualify? But because I was thinking, I thought that if your business is within the same field, maybe there are some exceptions, or you really have to quit your business job in order to work for somebody that's big so you can get a mortgage.
Let me look into that as far as exceptions go. If you're in the same line of work, there may be an exception for that. But also, if you're a recent college, because you're talking about first-time home buyers, if you're a recent college grad, and you've had your job for a couple of months, whatever, you don't need 2 years of income. We just have to look at your current salary, whatever you're making. Also, if you're a student before that, we'll ask for your transcript as well.
Yeah, but there's no age limit. It's like if I graduated college, like
you're 22, you can get a mortgage. Yeah.
No, I know, but like if I'm 40 and graduated, if I graduated college, like 10 years ago, and now I'm serious about my work. I never had a job, of course. I'm just teasing. No,
I was trying to work out the scenario.
All the scenarios.
No, because other people, they realize that I really want to buy a house. I want to turn on my future, but I've been renting because nobody can approve me for a mortgage. But I'm building my life now, and and I got this job 2 months ago. Can I qualify? But you don't have 2-year history, but you have a W-2, but you're just recently employed. Can you already get a mortgage like that?
If you just start a job and you you can get a.
Perfect.
Yeah. So what about if there were, like households where one is a W-2, one is a 1099? Like, how would that affect their buying power in this market right now?
One is a 1099, one is a W-2.
Yeah.
It's the same. We just have to assuming they've both been. 1099 has 2 years of history and everything. It's the same. It's the same thing as if both were W-2s.
Yeah.
So
if it's 1099, correct me if I'm wrong, if it is a 1099 and he's been having 1099s for 2 years, that's already considered you're approved for a mortgage for a certain amount. Yeah.
Right.
But the W-2s, it's easy because if you got a W-2 and you have offer employment, 3 months, how many months should you show your employment? 2 months of employment? For W-2?
No, you just need the last two. 1 month, basically.
Last
1 month.
pay stub.
Last 2 pay stubs, basically.
Last 2 pay stub. And then
And
you
the
check your bank
qualification-
statement, right?
And bank statements as well, because the bank statements is kind of like it's the cash to close. We want to make sure that you have enough cash to close. And you were talking about qualification. So here's a quick, if you were trying to figure out how much you qualify for, based on where we are with the rates right now, take your annual income and multiply by 4 to 4.5. That's a ballpark estimate is how much you qualify for. So a person that makes $100,000 a year, they'll qualify for roughly $400,000 to $450,000 a year. Now, if you want to get a condo,
Again, so 100, like if you make 100,000, divide by 4,
Multiply
multiply
4.
by 4. Okay.
That's a ballpark estimate. Now, unless you have to look at the condo. If you get a condo, you have to look at the condo fees.
Condo fees, that's why.
That's
yeah.
different, yeah, because some condo fees are usually, as a general rule, older properties have higher condo fees.
Yeah.
So if you have find a property where it's like, 400,000, but there's like a $800 a month condo fee, that's a different story.
Yes.
But ballpark, it's 4 to 450. Sorry, 4 to 4.5 of your annual income as far as qualifications go.
But less debts, though. What if they have a car, they have a lease? I mean,
Right, that's why it's a 4 to 4.5 is
Yeah.
depending on how much debt they have. Because remember, go back to the 4 C's: cash, credit, capacity, collateral. That's the capacity part, is how much income you have in your debt to income ratio. Then also how much cash you put down as well.
So this is a good news, so everybody can buy a house.
Yeah. There's a
You
program
know?
for everyone.
Yeah, it's good for everybody.
Yeah.
Like, don't say no. Like, just give it a try. And then if you don't qualify the first time, we'll make sure we have a plan for you to qualify in the next 6 months. How about that, right?
Yeah.
Yeah, I mean, also, credit, that's another big factor. How much people want to know, well, how much do I need to qualify for a home, based on my credit score. So FHA requires 580, but it's really hard to do. I would say 620 minimum with a...
That's low, right?
Yeah, 620, that's with if you have to have reserves and stuff. 640 or higher is pretty much you're good to go.
Wow.
For the best rate, you want 740 or higher. Now, if you have anywhere between 680 to if their credit score, is 680 or higher, 680 700 or higher, you want to do conventional. If it's below that, if it's between 640 to 680 or so, you probably want to do FHA, because you just get the better rate. The numbers work out better. Your monthly payment's going to be lower. The drawback of FHA is that
Mortgage insurance.
You have to put you only put 3.5% down, but you pay mortgage insurance. There's 1.75 upfront mortgage insurance and 0.85 annually of the loan amount. So the loan amount over time goes down, so that amount goes down as well. But eventually, you're going to want to refinance to a 30-year fixed, or maybe 15-year if possible as well. So that's pretty much credit. Also, how do you know what your credit is? If you're getting like a lot of people tell me, I have a 720 or whatever, they're basing it on the consumer credit card.
Yeah.
Consumer credit. That's different than mortgage. Yep.
Yeah, it's different.
It's generally about, is it 20 to 40 points difference. So if somebody tells you I got a 700 credit score,
That's
60 to 680.
Yeah.
So that's a very important note as well. It's not exactly the same thing, because
But
there's more.
Sometimes she goes, "Miss Christina, my credit score is like 820. What happened? It's only 750. You're still good."
Yeah. And
Yeah.
people freak out about the rates as well. Another thing I want to talk about is like, oh, what if I get my credit check? I don't want to submit an application because I don't want to get it'll ruin my credit.
Yeah.
It's not going to ruin your credit. I mean, there are 5 factors when it comes to your credit. So the biggest factor is payment history. That is 35% of your score. So there are different milestones: 30 days late, 60 days late, 90 days late. Okay, so if you're like 15 days late, you may pay a late fee, but it's not going to impact your credit until you hit the 30 days. That's the first milestone. Each one you hit, the more it's going to impact you. So the biggest factor is payment history. You got to pay your bills on time. Bottom line, don't miss that. Set up auto pay if you have to. Whatever you got to do, just pay your bills on time. The second biggest factor, which is 30%, is your credit utilization, which means how much of your credit are you using. So in other words, if you have a $10,000 Visa card with a $10,000 limit, and if you're using 5,000 of the 10,000, you're still fine. You're still halfway there, but 50% is kind of high.
It has
That's
to be
good.
30 at least.
Max of 30.
Yeah, 30. Yeah, ideally, if it's lower than 30, like 10% or lower, the better. So if it's even lower than that, but you don't want more than 30. Even though it's perfectly fine. You can definitely use up to 10,000 for that particular card. It's going to adversely impact your credit score. We also have a program where if you check your credit, and we have a tool where it'll tell you, hey, in the next 30 days, if they do X, Y, Z, they can bump the credit by 40 points or 20 points, whatever. So if you're kind of on the fence, you're kind of close, you want that, you have a 610 credit score, you don't quite qualify, we can say, you know what, lower your Visa card or American Express, or lower your whatever
20%,
debt.
then you can bump
And
up your score.
That is correct. That is correct.
So what I'm hearing is that, guys, you can just qualify for a mortgage What are you waiting for? Right?
I wish it was that easy.
Stop renting.
No, it's not.
I
No,
wish
of
it was
course
that
it's
easy.
not easy, but it's like I think people don't understand like the USA is a very good country because like it gives you all these opportunities
Yes.
out there for you. You know what I mean?
Absolutely.
It's like
You
like
just need
how can,
guidance.
yeah, you just need guidance on getting it, you know, what you need to do and stuff. You know what I mean?
That's why we're
Yeah.
here.
Yeah,
And
that's
Omar's
why we're here to
Speak to local
Professional,
professional.
yeah.
Speak to a realtor that knows the market, that knows what they're doing, and speak to a lender as well because you have to know the customer's situation, understand their goals, and then provide them the loan that adjusts their or addresses their needs and their goals. That's what it comes down to, basically.
Great.
Um,
Now, I heard this. Is it true that if there's a lot of lenders out there, and for some first-time home buyers, they might not know which lender to go with, which one has the relationship or would really understand their needs. If we have viewers out there that are listening, thinking about purchasing a home in the next year, and they don't know how to choose a lender. Maybe they're out there, they haven't shopping around, haven't touched base with a realtor yet. What are some things that you would say that they should look for as far as a lender, and should they shop around as far as like which lender they should actually go with?
Okay, great question. So when you put an offer down on a property, the listing agent, when they field offers, I would say there's 4 tiers. The best offer is cash. Cash is king. You just can't beat that. It's just the reality, The second best is a local lender. Third, I would say, is a national bank, like Wells Fargo or Bank of America, whatever. Then the worst ones are online banks and credit unions. They're slow, and they got a very poor closing rate. So why a local lender versus say a national bank? We work around the clock, 7 days a week. We're not 9-to-5ers. If you want to get a hold of me, it's not very hard to get a hold of me. You can call me, text me, email. That's pretty much the case for most lenders. So we know the market well. We're available all the time, and national banks, again, they're not, the reason why they're 9-to-5ers is after 5 o'clock. It varies between bank to bank, but they get a very small commission. So they get a big salary, small commission. That's what it comes down to incentives.
Right.
If you don't do the loan, I'll do whatever I can if it's possible to close the loan, I'll do whatever I can to close the loan. Otherwise I don't get paid. It's just incentives. So
it's for professionals. Yeah.
exactly, that's why I would recommend going with a local lender. I'm a local lender myself, so I may be biased, but that's just how I look at it. That being said, like which local lender?
Yeah.
Even if you're outside of the DC metropolitan area, if you're in Nebraska somewhere, well, how do you know which local lender to pick? I would say it's going to vary between one loan originator to another. It's just going to vary. Talk to some people, get a feel for them. Do you connect with them? Do they understand you? Do they understand your goals and your situation? After that, I would say you want to go with a lender that has like a wide array of products. Like for us, Intercoastal, we have our own portfolio programs, which is our own money. At the same time, we have other people's money as well.
Yeah.
We do have like correspondence with a bunch of other banks, so we have access to their products as well. So we have a very wide range of products that we can offer to our clients.
Yeah, I always it sounds like I'm biased here, but I really wanted to work with local lenders because, like with online I had experience when we're at the closing table and this person is really insisting on using this online lender, and at the last minute we don't even have disclosures. The lending paperwork. Oh, it's approved. Oh, it's California time. All these excuses, right? And you cannot get it to close. And I said, you know what? I really need you to go and look at the local lender. We can do an extension of 10 days. I already pre-talked to the other agent just because I already know what anticipate what's coming. And of course, your client doesn't want to listen to you sometimes. So, you wanted to have a game plan already for them so that they know that you have your back if something doesn't happen. So true enough, the loan got closed in 10 days and the loan is still pending there with the other, with the online lender. But if we don't have that capacity to be able to have local lenders, we couldn't be able to do the deal. And with local lenders, you'll be able to call them and say, hey, what's going on with the loan? Like, you know where to approach, not like hide in somewhere.
Other
you
times
know?
Collaborate better and collaborate. 'Cause
Yeah.
you're actually a team,
Yeah.
And I got a story here also. So you're talking about a different time also. So years ago, I was looking to buy a commercial property, and my company had a credit union. So I had heard that credit unions have lower rates than banks.
Oh, yes. I always hear that.
Yeah. So for those of you that are not familiar with credit unions, they're nonprofit, which is why they can, maybe squeeze out a slightly lower rate because they're nonprofit. So I was looking to buy a commercial property in an apartment building, and my company's credit union was in California, so it was a different time zone. That's when you mentioned that kind of reminded me of that. But here's the situation I had. I was looking to purchase a apartment complex, and it was an auction, basically.
Yeah.
It was an auction. And I submitted my application, went back and forth. Then at one point, I was like contacting them, like emailing them, calling them. And of course, if you call at 5 o'clock, they're not picking up.
Yeah.
They're not picking up.
Yeah.
Literally, like, they're at the doors. They're clock
Yeah,
watchers.
yeah.
They're clock watchers. I mean, like, so at one point they stopped responding to me, and I was getting concerned because I want to make sure I get the loan went through
Yeah.
before I put the offer
Yeah.
down, right? And as it turned out, the lady had some kind of a personal issue, and so she just wasn't
She
at
dropped
work.
the ball.
Well, no, she just wasn't at work for a week, and it was on her desk because she wasn't at work. They're 9 to 5ers. They don't check email.
Oh, my
They don't
God.
check on their phone. They don't pick up.
Yeah.
You can't text them or call them. They don't have their personal cell
Yeah,
phone
yeah,
number.
yeah.
They just show up at the office. They'll pick up their office phone, and if they have a personal issue, they're not going to work. So I was a little frustrated with that. Then I went to when she finally came back, so she got her part done. Then she would send it to the next person, because she has to go like processor, underwriter. Then at some point, the other person stopped responding to me. It's a true story. I'm not making this up. It's a true story. And I'll call them, text them, and I was really frustrated. And I was getting concerned also. I wasn't sure if it was going to go through or not. As it turned out, she got sick. So she was out for a week. Now, luckily, and when she came back, they got it through. So I got the loan approved on time because I had such a huge cushion, and it was at auction. It was well in advance of the auction. But if it was a 30-day close, I would not have been able to close on that. It was a commercial property, but that was my one and only experience with the credit union. It was commercial, but I was pulling my hair out. I was like banging my head against the wall. I was really frustrated. So
God.
I'm not saying they're all like that. Mine's probably more of an extreme case, but that's not going to happen with the local lender. I mean, like I'm having surgery on Friday, and
Oh,
I'll
you
be
have
out.
surgery?
Yeah, I'm having
Oh.
surgery on Friday, and whatever's outstanding, I'm gonna have a team, or I'm still gonna check my phone, and I'm not gonna be actively working 8 hours or whatever all day, but like
Yeah,
I'm gonna be
usually make
available.
sure. Yeah.
just not while I'm on the surgery table.
We hope not.
No, we're gonna call you.
So
No. Yeah. So, what advice do you have, like, for our listeners out there and for people who are watching? What advice do you have for them for just getting a loan in general?
speak to a local lender. Just tell them what your goals are. Tell them, talk to them. And if you are interested in buying, if you're just not just dabbling, if you're actually interested in buying, submit the loan application. That way they can check your credit score. They'll see how much assets you have. They'll assess your situation. And they may tell you right now you're not qualified because your credit score is a little, say it's, for example, we said if it's 610, come back in a month. If you do X, Y, Z, we'll get you up to 640. We'll get you, or they'll tell you there are always alternatives as well. So if you don't have the cash to close, so cash to close is your down payment plus your closing costs. So if you're a first-time home buyer, assuming you qualify, you could put down 3%.
And then let us worry about the rest, the agents. No, because we can negotiate that as part of closing costs for
You
sellers.
can, yeah. So let's just say a $500,000 property. So 3% of that as a down payment is $15,000. Allocate another 3% for closing costs. So you're looking at another $15,000. So you're looking at roughly ballpark $30,000. So what if you want to buy that $500,000 property, but you don't have $30,000? So there are options available: credit, lender credit, seller credit,
Mom
gift
credit,
funds. Gift funds, exactly. So a gift fund is a relative giving you a gift, and it's got to be accompanied with a letter stating that it's a gift, not a loan to be repaid. That's another option as well. Or if you don't have, if you have no options at all, they'll tell you, hey, right now you have like $20,000 to save up $10,000 or $5,000 in the next
Then
6
you
months,
come back,
whatever,
yeah.
and come back. So speak to a local lender and just let them assess your situation and tell them we'll give them the best advice that we can give them, just depending on their situation.
That's great. That's great. But right now with the current market conditions, we can get seller credits. So, I would advise people have good credit, and with 3% saved up, just come talk to a professional, and it will help you get situated.
Yeah, and we have one program for Virginia only where it's 0 down payment and about half the closing costs are covered.
Oh wow!
So
Tell us
for
more about
qualified
that.
buyers, yeah. So it's through FHA. The underwriting has to be done through.
And there's a loan limit, right?
Yes.
I mean, I'm sorry, income limit.
There's both.
There's both. Okay.
Yeah. The thing about that is that it's 0 down and about half the closing costs are covered. That being said, you have to qualify for it. I have to look at the exact it changed for 2023. I have to see what it is. It's going to be roughly like 168, I think.
168,000
Don't
and
quote me the exact number,
500,000. Yeah.
That's for a 2-person household, up to a 2-person household. So, and the loan amount was $550 for 2022, but I will see what it is for 2023. So $550,000 is the loan limit here. That's in Virginia only, by the way. It's not include Maryland or DC. So the advantage of that is that, let's just say you want to buy a house now, but you don't have the money up front. So this is actually pretty good for a lot of younger buyers that, let's just say, are recent college grads and they have good credit, they have a good job, got a good salary, but they haven't had time to save up money. Well, now they can use this program and buy a property now. Let's just say a $400,000 property, and rather than wait a year or two. Or, if you wait a year or two, number one, the advantage of buying now is you get to move into a property.
Yeah,
You're a homeowner.
now.
You get to tailor the home however you want it. And as we know, home prices generally go up over time. So you're probably going to have equity. And you're also going to be paying into the loan rather than waiting a year or two. So those are all the advantages of buying now. Then eventually you're going to want to refinance when the rates drop. So because you have to pay mortgage insurance.
So your income is based on tax returns. Like for example, for self-employed owners who would have like a 400,000, let's say, gross income, and then their net, they charge up
so many
everything.
write-offs.
So many write-offs, right? So they make like, let's say, 70,000 net per year, or even less. But so how would that translate? Can they qualify for the program?
It's the loan again.
It's the loan, right?
Yeah, that's what it's funny.
No, because you were saying the income is 168,000. So
Yeah.
is that gross or is that the net?
that's your gross income.
That's your gross
That's your
income.
gross
So
income.
if you make a gross income of, let's say 300,000, but your net income in your tax returns is 76,000. Let's say
We use 76,000. Yeah.
you use 76,000, not 300. Therefore, they can still qualify for that program, right?
Correct.
Okay, yeah, it's pretty good. See, all these business owners out there, you can get that incentive, 0 down payment with 166,000 income cap, and get a house with no money and less
Well, the issue with business owners generally is not so much cash up front; it's the
qualifying.
the loan because there's so many write-offs. There are people that on paper they make way less than they actually make.
Yeah.
So
Yeah.
that's just the reality of it.
Yeah.
I mean,
Well.
they make way less than they make. So the problem they face is they have the money, but they can't qualify for. They want to buy $1 million property. They're like, you look at their income, it's like you only make 100,000, quote unquote 100,000, but in reality
They make like 300, 500. Yeah.
yeah, exactly. So they can't qualify for that $1 million property, even though they can definitely pay for
But
it.
do you have like bank statement? That's why the bank statement portfolio loans came
We
out,
have to
right?
look at them all. Yeah, we have to look at it all. We have to look at when it comes to self-employed people, we have to look at 2 years of history when it comes to
Because
personal
sometimes their income
business.
is like this in the tax return, but their bank statement shows otherwise.
Yeah.
You know what I mean? So how would you base it as a lender?
We look at the income, whatever, we look at the personal and business tax returns, and we just base it on that.
Okay.
That's the situation they face. Is it's just that they make the money, but on paper it's a different story.
I know. Yeah. Well, they can. I guess it is what it is.
So business owners that are in that situation, would you recommend them if they're trying to buy a house in 6 months, should they talk to you 6 months ahead of time, or does there need to be more lead time in order to prepare, or is it a year because it depends on the tax returns?
That's a very good question. It depends on if they qualify. They wouldn't need much of a lead time at all. Otherwise, we can give them a little advice here and there as far as like.
Advice in your tax returns. Okay, this year you're gonna file this one, the correct one, right now, in order to buy a house. Yeah, I've seen that happen. Honestly, like, it's like, we need to get an adjusted tax return because your income is so low, but you don't earn that much. Oh, there's just a mistake, and then they.
Well, that can
Anyway,
also be offset with there's the higher down payment, so they got to
Yeah.
put down 40% or 50% down payment
Yeah.
rather than 20%.
Yeah. Well, sometimes they like to do that. I just put a higher down payment.
That's
so.
that's the solution or alternative, I should say, for a lot of business owners. If they have the money, but their income isn't that high, apparently legally, but it's not that high. Then put a large down payment.
So Omar, if they want to reach you, how can you be reached?
Through
They
you.
don't-
Contact
okay.
Christina. Contact Christina or
Okay.
email me
Only.
directly. It's Osadiq, OSADIQ, at icmtg.com. That's Intercoastal Mortgage. Or you can reach me on Instagram at homeloan_Omar. It's my handle on IG. So, yeah, it's not very hard to get a hold of me.
Of course, yeah, and we're trying to get the millennial market to really just take the plunge and take the risk and be a homeowner this year, next year, 2023.
Absolutely, and it's not that hard. I talked about the 4 C's: cash, credit, collateral, capacity. We talked about cash, that's a down payment and closing costs. We talked about credit, and we talked about capacity, and the other one is just collateral. That's just your appraisal. That's got to be done after you put the offer down and appraisal's done. But beyond that, just submit an application. We just look at 222. So we have CCC, 4 C's, and we have 222, which
What's
is
a
your
222?
Yeah.
last 2 years of
W2s.
W2s, last 2 W2s, last 2 pay stubs, and the last 2 years of your last 2 months of bank statements.
Oh my goodness!
So it's
2
very
years of-
simple.
Of bank statements.
Yeah,
Awesome. Yeah.
it's very simple, very easy to remember.
So I think we covered much about what you need to know about mortgage and the mortgage lending industry, but we'll like to welcome Omar back. I think what we can do is also do a question and answer, and when we do one live, and then they can just ask questions.
Absolutely.
I'd love to
Yeah.
come back.
Yeah. Omar, thank you so much
Thank
for
you.
being
Thank you for
here.
having me. I'm
Very
Yeah.
informative.
Glad to hear that.
Something new.
I definitely did. Well,
Congratulations on the podcast, and I hope it
Oh.
goes really, really well.
Absolutely, with your help and with everybody's help with the viewership, and I hope we can give relevant information so that you guys can learn from us, as your trusted professionals.
Yeah, and if I may add one thing, it's just Christina is really passionate about what she's done. She's, and I'm not just saying that. She's just in working with her, she's very passionate. She cares about her clients, and she's got a wealth of knowledge and a wealth of experience, especially in this area, because you want to know you want to know a realtor that knows the market really well. So definitely reach out to her.
Thank you.
wonderful. Well, thank you again, Omar, for all of the valuable information and different strategies that our clients can take advantage of as far as first-time home buyers, business owners, and what they need to do to prepare to just make this truly an investment. And the financing part is one of the biggest pieces. So thank you so much for sharing your wealth of knowledge. And everyone here from Sisonhomes, we just want to thank you for joining us, and we look forward to seeing you in our next episode. Bye.
Bye.